So the topic we pick is mutual funds, ETFs, and index funds. Before we go into the details of these kind of funds, let's talk about a brief history of their development. Investment pooling developed in Europe from the 1700s. And in 1940, the US mutual fund market started to be regulated by Investment Company Act of 1940. The first ETF was introduced in 1993. As of 2015, the US mutual funds assets exceeds $19 trillion. And there are three types of investment company within mutual fund. The first type is closed-end funds. Closed-end funds are not redeemable once the fund is closed, but it can be traded through secondary market. The second type is open-end fund. Open-end fund offers continuously offers shares, so they are redeemable continuously and their underlying holdings can be changed continuously. The third type is unit investment trust. Unit investment trust offers units once and their underlying holdings are usually fixed with a stated date of termination. And the benefits of mutual funds are, first, they have professional management. Second, they are diversified. And this is especially important for small investors because the versatile size allows them to diversify their portfolio. And comparing to directly buying stock, mutual fund also provides cheaper fees and lower expense. In addition, they are easily traded, so they also provide great liquidity to the investors. And now let's talk about what mutual funds invest in. There are three types of investment that mutual funds make. There are three major types of investment that mutual funds make. One of them is investment in equity market. This accounts for 52.1% of the total mutual fund investment. And the second largest investment are made in the bond market, which accounts for 21.8% of the total investment. And the third largest is the money market, and this accounts for 17.6% of the total investment. And the three largest mutual fund companies in terms of total assets are Vanguard Group, Fidelity Investment, Capital Research, and Management. And now let's talk about the fee structures of the mutual funds. There are two types of fees for mutual funds. One of the fees is called sell load. Sell load is a one-time fee paid by the investor. The average sell load incurred by investor is around 1%, but it can be as large as 6%. And the second type of expense is ongoing expense. Ongoing expense is charged to cover portfolio management, administration, compliance, shareholder service, record keeping, distribution charge, and other operating expense. And the total expense ratio is a fund's total expense expressed as a percentage of its total assets. Various studies show an average active managed mutual funds expense ratio is around 1 to 1.5% per year. And besides the actively managed fund, there are also index funds, which are passively managed. An index fund is a type of mutual fund with a portfolio constructed to match or track a component of a market index or benchmark, such as the S&P 500. An index mutual fund is said to provide broad market exposure, low operating expense, and low portfolio turnover. And comparing active and passive funds, the majority of active funds across all categories fail to beat their benchmarks. And as the analyzed time of period increase, a very small percentage of active funds beats their benchmark. In addition, index funds typically have lower turnover, lower fees, so they are more tax efficient than active funds. However, there are only less than 13% of US traditional mutual funds assets that are invested in index funds. And besides index fund, there are also ETFs. An ETF, or exchange traded fund, is a marketable security that tracks an index, a commodity, bond, or a basket of assets like an index fund. Unlike mutual funds, an ETF trades like a common stock on stock exchange. ETFs experience price change throughout the day as they are bought and sold. ETFs typically have higher daily liquidity and lower fees than mutual funds, making them more attractive to individual investors. And there are multiple types of ETFs. One type of ETF is equity index ETF. This type of ETF follows US or global or emerging market equity market indexes. The second type of ETF is regional equity ETF, which follows indexes for a particular country, for example, India, Japan, or UK. And the third type of ETF is sector or industry ETF. This type of ETF follows an industry index, for example, energy or technology industry. And the fourth type of ETF is the bond ETFs. They follow treasury or high yield bonds. Besides the traditional ETFs, the ETF frontiers are now moving towards active management. Some ETFs are now actively managed, not based solely on an index. One example of this kind of ETF is factor ETF, also known as smart beta. Smart beta ETF focuses on factors like low volatility, momentum, and quality, instead of just focusing on one index. And the top 3 global ETF providers are iShares, the ETF branch of BlackRock, Vanguard, and State Street. And this completes our presentation.